What do you see are the strongest advantages of the DBL fund being an evergreen fund versus other evergreen funds, syndications, or even self-managed investments?
I'll start with other evergreen. So other evergreen, normally large institutional REITs or even just a private placement fund. And if you dig through the numbers, they are not truly putting the investor in the greatest position. It's almost like, hey, you can kind of throw your capital in with us and like help us with the capital part. We'll find some nuggets here, some breadcrumbs for you at the end of the deal. I've been through it in them when the market has been going up like crazy, and they still can't pay anything out. I'm like, what are you doing? Because they have no efficiency. They have no profit margin. They're buying full price retail, just whatever's easiest to get a hold of. They just know how to raise capital, and then they're not able to pay out very much. So the bigger they are, usually the busier and the messier all the pieces are in the middle. You're paying for their high rise in Manhattan. You're paying for their marketing campaigns on CNBC. You, the investor, are paying for those things. So in a fund like this, the efficiency, it's way more efficient as an evergreen fund, really feeling more like you're in it as a private investor. That's what it is, a PPM, private placement. So you are in as a private placement partner in the deal, not just some retail buyer kind of just attaching themselves and getting whatever little dividend they feel like paying out. So that's a big difference in large evergreen funds you'll find versus a small to medium sized evergreen fund that operates much more efficiently. Then there's syndications where inside the deal, the returns can be great or the deal could not go well. And you just won't know. But the great deals just feel really great. And the ones that don't work, we just kind of like try to forget about them and move on to the next one. You have to play that game and you're tied up with those two. And it's just that it'll be tied up and then it'll come back. And it may be tied up and not give you anything back or give you less than you put in back, or you'll be tied up and you'll have a great return, but then you're out shopping for the next one. And that's where that dead zone, that dead time comes in. If it takes you 3 or 6 months before you get into the next one and you string those together over 10 or 20 years, and then you do the math on what you actually made over 20 years for the amount of capital, that return is probably less than that. I made 30% IRR on that deal, or I made this on that deal. That's great, but how long did it take you to get into it? How long did it take you to get into the next one after that? Oh, 6 months before you found it and 6 months after that? Well, you just cut the number in half. Plus, is it very passive if you're having to like investigate every one of these deals before you go into them? And is it diversified if it's just one project? Probably not. So that's a greater advantage of going to evergreen, is if you're saying, hey, I really want it to work more efficiently. Maybe I won't be able to brag about that one deal did that great, but that's going to work across the board, probably beat the real IRR number.